What if I told you the world's biggest initial public offering isn't happening on Earth, and your gold stash is the secret fuel for the mission? Something massive is shifting in the material layer of the economy, and the smart money is moving before the rest of the world wakes up. G'day, Gain Squad. Let's see where the smart money is flowing today as we break down the SpaceX IPO madness and the gold price surge. We are deep diving into why copper and silver are the new orbital essentials, and how the latest Middle East ceasefire talks are rattling the charts. Jump up and under, let's get into it. Because today we are optimizing entries for the most high-stakes market window of 2026. Before we find the alpha, remember, I am a tech strategist, not a financial advisor, so do your own research and don't bet the house on a whim. Here is the big question for all you gold getters. Is the SpaceX moon mission about to trigger the greatest commodity squeeze in human history? Drop your thoughts in the comments, smash that like button to help the algorithm, and subscribe to Goldie Gains so you never miss a Ripper update. Let's talk about the absolute scenes on Wall Street bets this week, regarding the SpaceX initial public offering. The word on the street is that Elon is aiming for a June 2026 listing, with a valuation of $1.25 trillion. Traders are absolutely frothing over reports that there will be no traditional 6-month lockup period for this launch. This means the second those shares hit the market, it is going to be a total free-for-all for retail and institutional players. We've already seen a massive surge in the Destiny Tech 100 fund, which is up 23% just on the IPO buzz. Other space names like Rocket Lab and EchoStar are catching a serious bid, rising between 3 and 6% in the last 48 hours. This isn't just a tech story. It is a structural repricing of the entire orbital frontier and the materials needed to build it. The smart money knows that to own the stars, you have to own the physical inputs that get you there. SpaceX is already commanding nearly 80% of the launch market, which is a moat deeper than Sydney Harbour. But the real game is Starlink and its global connectivity, which is generating the steady cash flow that makes this IPO possible. If you aren't watching this sector, you are basically flying blind while the rest of us are prepping for liftoff. Let's optimize this entry into the commodity demand that this space race is actually creating. The space industry is becoming a massive vacuum for high-grade copper, silver, and gold. Think about it. Every satellite and rocket needs conductive materials that can survive the extreme environment of low Earth orbit. Copper is currently trading around $6.08 a pound, and the demand for data centers and space hardware is only growing. We are looking at a potential 30% supply deficit in copper by the middle of the next decade. Silver is also in a tight spot, heading into its 6th consecutive year of structural supply deficit. Silver is currently sitting near $78.75 an ounce, and its role in clean energy and aerospace is vital. Then you have gold, which is the ultimate shield against the radiation and heat of outer space. The space industry isn't just about software, it's about magnets, alloys, and processed minerals that are getting harder to find. The strategic premium is shifting to the material layer, where the bottlenecks aren't capital, but the actual atoms we need to build. If the IPO raises the expected $75 billion, that is a massive war chest for SpaceX to go out and secure its supply chains. We are seeing a new era of public-private convergence, where materials are the new oil. Investors are realizing that you can't have a digital revolution without a physical foundation of metals. This is why the commodity space is looking like a proper golden entry for those playing the long game. The market's having a bit of a wobbler today, so let's look at what is happening with the energy sector. WTI crude oil has been bouncing around $98.32 as of April 17th. The OVX Oil Volatility Index is sitting at a very spicy 72.23 right now. This volatility is being driven by the naval blockade in the Strait of Hormuz, which has sent shockwaves through the global supply. OPEC production plunged by nearly 8 million barrels per day last month because of the conflict. Washington and Tehran are reportedly eyeing a ceasefire, which has pulled oil back below the $100 mark for a moment. But let's be real, the supply shock is expected to be persistent, which means inflation isn't going away anytime soon. When energy prices stay high, it exerts a stagflationary pressure that usually makes gold look like the only safe harbour in sight. The market is transitioning from an inflation shock phase into a more nuanced geopolitical diplomatic phase. But with shipping still restricted, the energy premium is staying baked into every single trade we make. Traders are using weekly options to hedge these risks with pinpoint accuracy as the headlines shift every hour. It's a wild ride in the oil patch, and the OVX tells us the storm is far from over. If you are chasing gains, you need to be watching these energy flows like a hawk. Now, let's talk about our favorite shiny metal and what happened between April 15th and April 17th. On Wednesday, April 15th, gold copped a 1.1% drop as traders reacted to the first signs of ceasefire talks in Pakistan. By Friday, April 17th, the price recovered to $4,795.26 an ounce. Gold is on track for its fourth consecutive weekly advance, which is a massive show of strength. Even with the diplomatic noise, gold is holding near its one-month highs because the structural case is just too strong. The US and Iran are considering extending a 2-week ceasefire, but the smart money is still cautious about the long term. We are currently trading in a range between $4,750 and $4,850. The market is balancing the reduced safe haven urgency against the underlying risk of a breakdown in talks. It's a classic tug-of-war, but gold has stayed incredibly resilient through the whole ordeal. Central banks are still scooping up physical gold behind the scenes, draining the supplies like there is no tomorrow. In February alone, they grabbed 27 tons of the yellow metal to diversify away from the dollar. This official sector demand is providing a massive floor for the price, regardless of what the retail crowd does. We aren't in a traditional recession, we are in a currency reset, where gold is the neutral reserve anchor. This is a proper golden entry for anyone who understands that the old financial rules are being rewritten in real time. Let's bring in the heavy hitters, starting with the legendary Ray Dalio. Dalio has issued a massive warning that the United States could face a financial heart attack by 2026. He's looking at the 7th stage of the empire cycle and seeing red flags everywhere. Between the massive debt, the money printing, and the trade wars, he thinks a global reset is inevitable. Dalio's survival playbook is simple: gold, inflation-linked bonds, and proper diversification. He says the combination of a tariff war and dollar weakness is a recipe for a massive economic shakeup. It's a heavy perspective, but when a man like Dalio speaks, the smart money usually listens very closely. Meanwhile, the team at JPMorgan is focused on the private credit market and the era of public-private convergence. They are seeing yields in direct lending that are 300 basis points above traditional high-yield bonds. JPMorgan expects 2026 to be a strong year for exits and distributions, as long as a recession stays away. They also see gold trending upward, supported by the ongoing weakness in the greenback. It's a more optimistic view than Dalio's, but they both agree that gold has a pivotal role to play in a modern portfolio. We are seeing a shift where private capital is expanding its exposure to metals for hedging purposes. The JPMorgan outlook suggests that the financing costs for big deals are finally starting to ease. Let's see how the other big institutional players are positioning themselves. Goldman Sachs is staying loud and proud with their bullish forecast for the yellow metal. They have recently pushed their year-end gold target to $5,400 per ounce. Goldman thinks the combination of massive ETF inflows and central bank buying will drive the next leg up. They described the current situation as the largest ever supply shock for global crude markets, which helps the gold case. Their analysts are calling any short-term dips a buying opportunity for the long-term target. Now, let's talk about Cathie Wood and her ARK Innovation Fund. Cathie's flagship fund has absolutely crushed the market over the last 12 months, rising 52%. But let's be fair, the fund is still down significantly from its record highs back in 2021. Cathie is still betting big on disruptive tech like AI, robotics, and of course, Tesla. Tesla has had a rough 2026 so far, dropping 19% as the market rotates into resources. But Cathie believes that AI will eventually determine the winners and losers of the next decade. While her traders have endured extreme volatility, she remains convinced that innovation is the ultimate alpha. It's a high beta play that contrasts sharply with the steady protection of a gold position. Now let's look at the latest macro data coming out of the States. The New York Empire State Manufacturing Index just hit a reading of 11 for April. This was a massive beat compared to the negative 0.5 that the analysts were expecting. It suggests that the US economy is actually expanding much faster than people thought. This strong reading is forcing the Fed to stay hawkish and keep interest rates higher for longer. We also got the latest US Beige Book, which says the war in Iran is keeping businesses on edge. Hiring and investment plans are getting complicated because of the new cost pressures from energy prices. Overall economic activity is increasing at a slight to modest pace, according to the Fed's report. Consumer spending is holding up, but businesses are definitely worried about the naval blockade. The Empire State beat adds pressure on the central bank to avoid cutting rates too early. A stronger than expected economy usually boosts the dollar, which can be a headwind for gold in the short term. But the gold getters know that persistent inflation often outweighs the impact of high interest rates. It is a complex macro puzzle, but the pieces are starting to form a very interesting picture for commodities. If manufacturing stays strong while energy is tight, we are looking at a classic inflationary backdrop. Now, let's talk about the most underrated signal in the market, the copper to gold ratio. This indicator just hit an astonishing level of 830 in early 2026. That is the highest ratio the industry has seen in 45 years, and it is a massive warning sign. A high ratio tells us that gold is performing well as a safe haven, but copper is lagging due to industrial stress. Usually, a lower ratio means strong industrial growth, but 830 is a signal of major disruption. It suggests that the global manufacturing engine is struggling under the weight of the energy shock. Dr. Copper is essentially saying the economy has a bit of a fever, while gold is acting as the ultimate insurance policy. This divergence is exactly what happened during the stagflation era of the 1980s. When industrial metals fall while gold rises, it shows a flight to safety and a shift away from leverage. For the smart money, this ratio is a leading indicator that a broader market correction might be lurking. It's a sobering thought, but it highlights why having a material layer allocation is so critical right now. We are at a crossroads where industrial demand is hitting a supply wall, and it's going to get messy. To wrap up the mission so far, gold is holding steady near $4,800 despite the ceasefire talks. SpaceX is prepping for a $1 trillion IPO that is going to supercharge the demand for copper and silver. Ray Dalio is warning of a financial heart attack, while Goldman Sachs is calling for $5,400 gold. Oil volatility is through the roof with the Hormuz blockade, keeping the energy-driven inflation narrative alive and well. The US manufacturing sector is surprisingly resilient, which means the Fed isn't going to be handing out rate cuts anytime soon. And that copper to gold ratio at 830 is the final alarm bell for anyone not protected by physical asset. It is a high-stakes game, but for the gold getters who stay informed, there is plenty of room in the pouch. So, what is your move? Are you loading up on space stocks for the SpaceX launch, or are you sticking to the safety of the shiny stuff? Drop a comment below and let me know if you think gold hits 5,000 before the SpaceX IPO actually lists. Smash that like button if you found this update useful, and subscribe for your daily dose of gains. Keep your positions tight and gains golden. I'll see you at the next close. Cheers!